Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. This man, all the way from Philadelphia, the city of brotherly love, Dimitri Parker. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. And there's a disclaimer. While trying to share my screen, if you guys are joining us for the first time, Will and I, we do this show in the morning to help answer any questions you may have about the Market Chameleon tools, data, or analytics. If you want to come on the show and ask your question live, we do provide a link to Zoom on the live chat. Click on that, takes you over to Zoom. Click on raise your hand. That will let you in. You could ask your question live. If you prefer to type your question, you can put that into the live chat. Will's watching it. He'll read them back to me. While we're waiting for more people to join and for questions to come in, what we'll do is take a look at the pre-market report, see what's trading in pre-market hours. If we could get some insights from that. If we don't have any questions, I'll navigate then to some of our new features or features that we've been doing updates, and we'll discuss that. We were talking about yesterday our minute-to-minute VWAP table, and I'll just continue on that unless we get some questions. I'll take the questions first. Okay, well,
perfect.
So pre-market trading, these are stocks trading in the pre-market hours. I'm going to come down here and we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. I see 85 stocks made our percentage gainers list, 78 on the decliners. So from this perspective, looks like we're lining up for a more bullish bias at the open. However, if you look at this list, you will notice that the list has a lot of small cap stocks, ETFs, leverage products, could be preferred stocks, closed-end funds, anything that is listed on a major U.S. exchange. If it's trading in pre-market hours, it could make this list. And what we want to do is start narrowing down this list to a smaller group of stocks to get some insights that way. And, before I do that, a couple of things, I know I've been getting emails, and this is all over the news about some of these regional banks. Still, issues there trying to get resolved. I think this is First Horizon. They were supposed to merge with TD Bank. TD Bank at this point bailed out, it's paying their termination fee.
Yikes.
Down like 40%. And, I think some of these banks were so calibrated on, zero interest rate policies that it's very difficult right now for them. And you could see that they can't push their deposit rates higher. They're still I think TD Bank is still at 0%, and they might be in trouble if interest rates continue to hold up here. And, that if they don't raise their deposit rates, are they going to feel the same thing where people just say, okay, I'm going to just move my funds to somewhere that pays more? Because now all of a sudden you are starting to see ads, 4.75% savings rate, 4.75%, CDs and money markets. And the longer this goes, the more these banks will have problems, holding on to their deposits. And they haven't had that issue for a really long time. So when everybody's zero, paying 0%, there's really no incentive to move your funds for risk-averse investors, right? There's nowhere to put it. No money market, no no checking, no savings, nothing. All of a sudden, we're already, a year into it? Well, and we're reaching 5%. So if you're paying zero, the distance between 0 and 5% is real.
Significant.
It's really significant. And if we stay here, this is going to, how do you hold on to those deposits, right? Because people at some point are going to be like, I'm not going to sit here and earn 0 or even 1% if everybody else is moving into, treasuries or money markets or alternatives. So it's at this point, it's significant enough that, banks that continue, I think, to sit on 0% interest rate, they're going to start probably feeling that their customers are going to start withdrawing deposits, moving them to alternative places.
Yeah, and that just escalates the problem, right? Because to meet those deposits, they're going to have to liquidate the bonds they hold, which are locking in a loss.
Exactly. Yeah. And I don't know if they all are, holding these bonds, these long-term bonds,
Well, I think that's the problem, right? They can't roll into the new bonds to pay higher interest rates because it's all locked in. Because then they would be losing on the spread, right?
They're going to lose, right? Which is another lesson, I think, out of crisis, out of these crises, out of mistakes and mismanagement and risk. Usually, you learn lessons going forward, so you don't repeat the same mistakes. And I think that the lesson going forward is that you have duration risks, and just because we go to 0% might not stay there forever. And a 10-year bond paying less than 1%, you don't just load up on it and pretend that it's always going to be there. We might not even go below 2%. A lot of people are buying these 10-year bonds right now with speculation. You're reading, we're going to go to 2% on these bonds. We're going to go to, below 2% because we're heading into a recession. And even if we head into a recession, the Fed's hands may be tied how much stimulus they could add through lower rates, because if you're going to a recession and you have inflation at the same time, stagflation, that's really bad. You're going to be in big trouble for a long, long time if you're going to run a stagflation economy. So their hands may be tied anyway, even if we're in a recession. How much can they lower rates without spurring without activating inflation again? So definitely, keeping out on by the way, these are preferred stocks. If FHN-D. So whenever you see this, that's a preferred stock. So you can see their preferred stocks are now also tanking 27%, 26%. And, the lesson there is if this bank fails, FDIC takes it over, those preferreds go to 0. And so is the common. That's the risk if they're in danger of failing.
When's this spread into the, when does it start this spread into the overall market, or does it?
Well, that's the question there. It's an interesting question because it's a little bit different situation right now than the 2008 crisis. Like the 2008 crisis started to spread quickly into Main Street because of the housing bubble, right? Like people were sitting on houses they couldn't afford. Too many loans were made, like there were short sales. You couldn't sell a house. It spread to Main Street pretty quickly, and those big banks had counterparty risks that spread, immediately to lots of different areas. But these regional banks, if they could contain them to, the investors in the banks, and if the FDIC does take over these banks, the customers are made whole, does it have a contagion? I'm not sure. it's at least not the same way as 2008, perhaps, right? Where 2008, we were in much bigger trouble because of how these big banks were so interconnected to many things, to many things out there. I'm not sure if these regional banks right now have that, have that same contagion, and they're looking at it, right? The Federal Reserves were looking at it.
Yeah, no, it's, I mean, I'm a little young, surprisingly, for anything, but I don't really remember the savings and loan crisis
It
back
didn't.
in the 80s and 90s, but maybe, that I think like a third of all the
A lot
savings
of them
and
failed.
loans ended up failing. And
Yeah, and right, and then it just kind of it flushed out, and we went back, right? So it could be a similar situation here. I think one of the worry right now, I think Rob was mentioning it's in the news, is those commercial loans. Those commercial loans made to office buildings, and because some of them are, I think, are like really struggling here. These office REITs, office buildings, where they're sitting on loans that may come due, and they've got issues trying to rent out their space. Even in Manhattan, in New York, in Manhattan, in California, they're having issues renting out that space. And I don't know if you could just repurpose those buildings and convert
well,
them to
you can
condos.
repurpose them, but it's a cost, right?
There's a cost to
I know everyone on this in the chat, most people have dealt with contractors and trying to renovate, right? It's not an inexpensive project. You're going to need a loan, right? And if the banks aren't loaning, the building's just going to sit there.
Yeah, I've seen them in Philadelphia. They have done that. They took buildings that were previously office buildings, even like hotels, and they repurposed them to condos and sold them off. So it's possible you could do it if there's just too much office space and you can't hold on to it and you don't think it's going to rebound. Possibly they could do that with the buildings, but you're right, it's a cost. They'll have to go, partner up with some developer and investors.
Yeah, and if the office spaces aren't being filled, there may be a problem selling. Just because you convert it doesn't mean people are going to buy it or rent it, right?
Yeah.
I mean, I know obviously New York, that may be a different story because it does seem like New York could absorb a lot more rental and condo properties, but I don't know if that's the same throughout the country.
Yeah. So that's an interesting story, how that will develop, what will happen. Will the office space, will it come back? And we're watching closely with this Chat GPT, with this AI, and we were talking about it this morning, how fast it's moving, that things that I was looking at a week ago to start, trying to feed the data and develop on it, all of a sudden before we even got started, there's an app already doing it, with data visualization and code interpretation. So it is moving so fast that you're not even sure, should we start work on this, because all of a sudden there's like a new tool coming out that makes it easier. And I think the point I was trying to make is that with these advances in technologies, in the AI, what will be the trend for these office, buildings, because you could really be productive working from home, and some of these office jobs might be completely eliminated, because the AI could do it. I think IBM said that they're going to replace, like, I don't remember, it was thousands of workers already. They said, we're going to stop hiring. We're going to replace thousands of workers with this AI.
And those aren't low skilled jobs, right?
No, those are really, like high skilled jobs. Like this is the first really disruptive technology where it's the high skilled jobs across the board, right, are in danger all of a
You,
sudden.
you really can't think of an industry that
It might
isn't
not.
ripe for disruption here. And
Yeah.
the disruption, unfortunately, is humans have to
Retrain.
figure out what else they're gonna what their next work environment's going to be, because it's going to change
Yeah.
a lot.
Yeah. Yeah.
Question is,
Look,
what's it do to the overall economy?
yeah, I mean, I think in the long term, it's probably gonna increase our productivity and make our standard of living better, I think. But how does it play out in the short term, right? Because
Yeah.
you're gonna have these imbalances all of a sudden. And when you have a large imbalance, all this, how does the economy absorb it? Because you don't want what happens when you have all these skilled workers out there really quickly getting losing jobs, and you can't just re-educate people to do something that fast when you have like millions of people potentially out of work in every industry, right? In every industry that you could think of. So pre-market mover, let's filter down this list. I'm going to use the filters here above in the ETF. I'm going to click on that, and we get a list of ETFs to choose from. So we have the broad-based ETFs. We have some sector ETFs. Let's take a look at SPY. Click on that, and that will filter the list below by holdings, stocks that are holdings in SPY. Here we see 11 stocks made our percentage gainers list, 19 on the decliners. So from this perspective, we're looking like a bearish bias at the open so far. Not a huge list. And of course, yesterday we had that interest rate increase. Market sold down after that. They indicated that now they're kind of in a more wait and see. They may pause and wait and see how the data comes in. If it's trending, which it has been, the inflation has been trending their way. So if it continues to trend their way, they're probably going to just hold it here until it hits their target. I think that's the indication they gave. So if there are no questions, Will, I'm going to navigate to the VWAP table.
We did have a new user who had a question. He didn't answer it back. If you want to take a shot at it, he said how to screen for calendar spreads, calendar strategy. He said, is that something you want to take or have him come back?
So we don't have a screener for calendar spreads. There's the only way right now to kind of do that is if you look at these alerts on the homepage. So go to Market Chameleon, and you could come in here and pick. Let me see where. So these are different alerts that you could choose from. So here's a bearish calendar spread. Okay, bullish calendar spread. So bearish calendar spread is when you have your strikes below the strike, bullish is above. So let's just say we're looking for a bearish calendar spread. Oops. Bearish calendar spread.
This is the landing page when you first come to Market Chameleon.
Yeah. So unfortunately, right now it's resetting to the new day. So I don't have yesterday. So we're not open yet. And right now, these are now setting up for today's. But what you could do is you come in here and you could start looking for calendar spreads. And if you want to look for a particular symbol, just type it in here. Like say, Apple, and click on that. So you're going to get the alerts for Apple. And if you have it set to calendar spreads, that's where, let me see.
Wow, look at that. That's awesome.
Yeah. again, there's nothing right now. So that's one way that you could do it, is just go into here. This is the quickest way, and this is scanning and pushing out those alerts. Okay.
Now that is that alert something that's trading, or is that alert something that's setting up with some sort of either theoretical edge or
yeah, so that
win rate
yeah, that's a good
edge?
question. Yeah, so that's an alert based on a theoretical edge. So it's scanning the markets and it's looking at a different calendar spreads. It's looking at the implied volatilities and the relationship between an option in 1 month versus the option in the other month, and then it looks at historical relationships, and when they line up, when it lines up as a an undervalued situation. So this calendar spread's looking at a long calendar spread, buying the outer, selling the near. When it lines up that it looks attractive from a historical perspective, then it creates that alert. And when you click on that, alert, it'll give you the details here. So it'll tell you the details in this box here, and then it'll let you select it. It'll come up in the options chain. Unfortunately, I'm not going to be able to show you an example until we open up, but you could bring up an options chain, and then it'll show you the legs. It'll show you like whatever, buy this one, sell this one. Then you could calculate it. You could see the payout diagram, and you could compare the IV Theo. Like right now, you're getting a 0.25 cent. I don't know which one I did. Okay, I sold the outer month. So here, you're getting a credit of 25 cents on average. If we look at historicals for similar options, it explains it here. Look at historically options with same amount of days to expiration. It looks for same distance away from the spot price. It looks, if it has earnings, it'll go back in a database and know that find data only that straddle that earnings in, that are similar to what you have picked here. And then it compares historically. To look at the implied vols converted to what it would be in today's prices and show you the average values, right? So then you could go in there and see, what, you could look at the theoretical values based on implied vols. You could look at the ranges that this traded. So I think this one wasn't even a calendar spread. I did a diagonal on this one because I did two different expirations, different strikes. So you could change that. But that's where, if you wanted to just go in, there's no screener like we have, like where you're, picking lots of different filters and stuff. But this is one place where you could go and just find ideas for calendar spreads.
Excellent. Miss PS says thanks. So that worked out.
Okay. Let me see. We only have like 5 minutes left, so I'm not sure if I have enough time to go into something new. If you have any questions, I'll take them, Will.
Well, we can do the VWAP table, I guess, tomorrow. We'll
okay. Yeah, so what I'm going to do is quickly, we talked about this for a couple of days, the different trading sessions. What we did yesterday was go to the VWAP table for regular trading hours. So this is regular trading hours. This is here a minute by minute summary of the trading. Okay. We call it VWAP because for each minute, how do we give that minute a fair price? What was the fair price that minute? It's the volume weighted average price, right? And that's where institutions, professional traders will reference VWAP prices. So these are the VWAPs minute by minute. We talked about here. I'll do another example. We have 4 minutes. So this is in Microsoft yesterday, and when we look at the VWAP table, we could go in there and try to find some interesting indicators or stories that may have happened throughout the day. So one of them is to look for specific minutes that something unusual happened. Okay. So one of the first unusual things is that was there a particular time period when there was a big spike in volume? And if there was, what happened that minute? So here we separated these spikes into 4 groups, right? First, on the one side, there's an interpretation that minute there was a big buy order or a big sell order. And then we take the buys and say, well, if we compare the VWAP price for that minute to the most recent price, is that buy order in the money or out of the money? Is he winning or losing, right? So if somebody bought it and the stock is going up, well, they're sitting on a profit, they're sitting on a win. If they bought it and the price drifted lower, then that purchase is sitting on a loss. So we see here yesterday what happened in Microsoft. We detected there were 4 big buy orders, 1 big sell order, and those big 4 orders happened right after 2, so that right after the Fed announced, right. Here's a 238, 240, and 256. So let's go and take a look at that. So here's at 2 o'clock, right? So right before the Fed announced, probably. So here's at 2. So this minute, we see that there's 194,000 shares that traded just that minute alone. And by our calculation, that's a 4.5%, 4.5%, 4.5 standard deviations above the average volume for this particular time of day. Okay, so we're looking at, our system is looking at different periods in the day, looking at what is typically trades minute to minute, and then it's filtering out any big volume. And why was this buy? Well, from the previous minute, we see that the VWAP price increased by 68 cents. Okay, so here's the previous minute, 159. It traded at 36.92. Then 2 o'clock traded at 307.60, up 68 cents. So to drive the price up, right, more buyers than sellers. So we consider that a big buy order to move it up. And we could see here, this E here is an indication that there was an event in the market, FOMC meeting, obviously. So right at that moment, FOMC comes out, somebody enters in, a big buy spurt. And we could see that didn't hold, and almost immediately, even on less volume, it started to sink, right? So what was the next? 238. Let's go look at that one. So you could see here at 237, it looked like something sold down, right? And then immediately 145,000, then somebody took it back up $1.25. And it looks like then after that, it started to decline. So, none of these. Here's one at 240, another buy spurt, and immediately sells down. So, that is shown that the overall market was weak. Plenty of liquidity on the sell side yesterday. Even with these big, they couldn't clean it up, right? Even with these big buy spurts, they couldn't clean up that often. So we had 4 of them yesterday. Couldn't hold on. Here's one sell at 237. Okay, we saw this one. And then, as you could see, we had closed at 304.40. So really, yesterday, it was an event-driven. There was pressure on the entire market. And that's what it was probably feeling, that this was just a broad sell-off after the Fed announcement. They were selling off the indexes too, right? It wasn't just Microsoft. This wasn't a Microsoft thing. This was a market-wide event. All right, well, we're after 9:30, so I'm going to stop right there.
Well, awesome job, Diva, as
All right.
always. And we'll continue, I guess, the VWAP discussion tomorrow, because it is a great new feature and we should learn everything about it we can. Thanks, Chameleons, for joining. Thanks for the questions. Great job, D. We'll see you tomorrow, my friend.
All right. Yep. Thanks, everyone. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, Chameleon.